The weekend warning. If you own silver, the next 48 hours will determine whether you protect your position or lose everything when markets open Monday morning. I am not being dramatic. I am being precise. Because while you are watching this video, while markets are closed, events are unfolding that will trigger the largest silver market disruption in modern history. And Monday morning at 9:30 Eastern, you are either going to be positioned correctly or you are going to be trapped. Let me show you exactly what is happening right now. Friday afternoon, 3:47 p.m. Eastern, COMEX released delivery data for February silver contracts. 14.2 million ounces standing for delivery. Registered vault inventory available, 18.4 million ounces. That gives them 4.2 million ounces of buffer. Sounds fine until you see what is happening this weekend. Between Friday close and Monday open, three things are converging that have never converged simultaneously before. February contract expiration mechanics, Chinese New Year supply disruption, and emergency CFTC review of position limits scheduled for Sunday night. Each one alone would stress the market. All three together this weekend creates a perfect storm that detonates Monday morning. Here's what you need to understand. The people who know what is coming, the institutions with inside access, they positioned Friday afternoon before close. They know about the delivery crisis. They know about the emergency review. They know what happens Monday. You did not know. Until now. You have this weekend to make decisions while markets are frozen. Monday morning, it will be too late. Let me show you the evidence, because once you see the data, once you understand the mechanics, you will realize this is not speculation. This is math. And the math says something breaks Monday morning. The delivery crisis. COMEX Silver works on a contract system. Every month, contracts expire. Most traders roll forward to the next month. They never take physical delivery. But some demand actual silver. Those are called standing for delivery. Right now, February contracts expire in 72 hours, and the numbers do not work. Here is the breakdown. Total February contracts originally opened, 87,000 contracts. Each contract is 5,000 ounces. That is 435 million ounces of paper claims. Throughout the month, most rolled forward to March or April. As of Friday, 2,840 contracts are standing for delivery. That is 14.2 million ounces of physical silver that must be delivered Monday through Wednesday. COMEX has 18.4 million ounces registered, meaning available for delivery. Subtract 14.2 from 18.4, you get 4.2 million ounces remaining. That is a 23% buffer. Historically, a 20% buffer is minimum safe level. Below that, you risk delivery failure. We are at 23%. We are one large delivery demand away from failure. But here is what makes this weekend critical. The 18.4 million ounces available, that number was reported Friday at close. COMEX does not update vault inventory on weekends. So between Friday close and Monday open, you have a 60-hour blind spot. Nobody knows if those 18.4 million ounces are still there. Now let me show you why they might not be. Friday afternoon, 3 large withdrawal notices were filed, 2.1 million ounces total. Those withdrawals process over the weekend. Monday morning, when vaults open, available inventory could be 16.3 million ounces, not 18.4 million. But delivery obligations are still 14.2 million. Your buffer just dropped from 23% to 13%. That is failure territory. And that is before March contracts start demanding delivery. March contracts, another 3,600 standing as of Friday. That is 18 million ounces. If 16.3 million ounces are available Monday morning and 14.2 million must be delivered this week, you have 2.1 million ounces left for 18 million ounces of March demand. The math does not work. Something breaks. The Chinese New Year factor. Now layer in the second crisis. Chinese New Year starts February 10th. That is 11 days from now. China shuts down for 2 weeks. Factories close, refineries close, logistics freeze. This happens every year, but this year is different because of the export restrictions. Remember, China refines 65 to 70% of global silver. Since January 1st, they restricted exports. Only 44 licensed companies can export, and they need government approval per transaction. Already, approved export volumes are down 73% versus last year. Now add Chinese New Year shutdown on top of existing restrictions. What does this mean for COMEX? Any silver that was going to come from China to refill COMEX vaults, it is not coming. Not for 3 weeks minimum. COMEX is operating on existing inventory with no resupply from the world's largest refining source, and they have to deliver 14.2 million ounces this week, plus 18 million ounces in March. Normally, COMEX could call refineries and say we need emergency supply, rush production. Not this year. China is closed and restricted. Mexico and Peru, the largest mining sources, their material goes to China for refining. Without Chinese refineries operating, that supply chain is broken. So COMEX is isolated. They have what they have in vaults right now, and what they have is barely enough if nothing changes. But things are changing. Withdrawals Friday afternoon, delivery obligations accelerating, March demand coming, Chinese supply offline for 3 weeks. This is a supply crisis with a hard deadline, and the deadline is Monday morning. The emergency CFTC review. Now the third factor, and this is the one almost nobody is talking about. Sunday night, the CFTC is holding an emergency closed-door session to review position limits on precious metals. This was announced quietly Thursday afternoon in a regulatory filing. No media coverage, no explanation of why it is emergency status or why it is scheduled for Sunday night. Position limits are rules that restrict how much silver one entity can control. Right now, the limit is 6,000 contracts, or 30 million ounces. That limit has not been enforced strictly. Some entities hold more through exemptions and spread positions. But if CFTC tightens enforcement or lowers limits, entities over the limit would be forced to liquidate immediately. Why does this matter for Monday? If the CFTC announces new position limits Sunday night, some institutional holders will be over the limit when markets open Monday morning. They will be forced to sell. Forced selling into a delivery crisis, into Chinese New Year supply disruption, into declining vault inventory. That is a liquidation cascade trigger. Now, I cannot tell you what the CFTC will decide Sunday night. The session is closed. But I can tell you this. They do not hold emergency Sunday night sessions for routine matters. Something is wrong. Something is urgent enough that it cannot wait until regular business hours. And the timing, 36 hours before February deliveries must be settled, that is not coincidence. My read, and this is speculation based on pattern recognition, the CFTC sees the delivery crisis forming. They see vault inventory declining, they see large, concentrated positions, and they are trying to force position reduction before a default happens. That means Monday morning, new rules could be in effect that force immediate selling. What happened Friday? Let me show you what the smart money did Friday afternoon, because their actions tell you they see this coming. Between 2 p.m. and 4 p.m. Eastern on Friday, unusual activity appeared in silver markets. This is documented, this is verifiable, and it shows positioning for a Monday disruption. SLV, the largest silver ETF, saw $340 million in outflows Friday. That is the second largest single-day outflow in the ETF's history. Institutional money exiting, not retail. Retail does not move $340 million in 4 hours. This is hedge funds, asset managers, institutional desks. They know something. COMEX March silver futures volume spiked 340% in the last 2 hours of trading. Open interest, the number of contracts that remain open, jumped 18,000 contracts. That is 90 million ounces of new paper claims created Friday afternoon. Why the rush to open positions before the weekend? Because they expect volatility Monday. They are positioning for a move. But here is the strange part. While March futures volume was spiking, February futures volume dropped to almost nothing. The contracts expiring this week, the ones that require physical delivery, nobody wanted them Friday afternoon. Why? Because taking delivery in a supply crisis is risky. What if COMEX cannot deliver? What if they offer cash settlement instead? Better to avoid February and go to March where you have more time. That behavior, avoiding near-term contracts in favor of forward contracts, that is what you see before delivery failures. It happened in palladium in 2001. It happened in rhodium in 2008. Traders smell trouble, and they roll forward to avoid being stuck in a default scenario. It is happening in silver right now. Physical premiums tell the same story. Friday afternoon, physical silver dealers were quoting 18 to 22% premiums over spot. That is elevated but not insane. By Friday evening, after close, premiums jumped to 28 to 35% in some markets. Why the weekend spike? Because dealers know they cannot get supply. COMEX vaults are tight. Chinese supply is restricted. Dealers are raising premiums to ration inventory because they do not know when they can restock. When physical premiums spike on a weekend, when markets are closed and nobody can arbitrage the difference, That tells you physical supply is genuinely stressed. Dealers are not raising premiums for fun. They are protecting limited inventory ahead of a supply shock they see coming. Now look at the options market. Friday close, silver call options for February and March expiration saw volume 8 times normal levels. Calls are bets that prices go up. Why are traders suddenly buying massive amounts of upside calls before a weekend? Because they expect a Monday gap up. They expect something over the weekend to change the fundamental picture, and when markets open Monday, prices will be significantly higher. All of this, the ETF outflows, the futures positioning, the physical premiums, the options activity, it all happened Friday afternoon into evening. The people with the best information acted, they positioned, and now you have this weekend to decide what you do. The 2011 precedent. Let me show you what this looks like when it breaks. Because COMEX has faced delivery crisis before, and the playbook they use is predictable. May 2011, silver hit $49. COMEX faced similar stress. Delivery obligations were spiking, vault inventory was tight, and they acted. May 2nd, 2011, COMEX raised margin requirements. Suddenly it cost more to hold silver futures. May 5th, they raised them again. May 9th, again. May 11th, again. May 16th, again. 5 margin increases in 2 weeks. That forced leveraged traders to either put up more cash or liquidate positions. Most liquidated. Silver crashed from $49 to $32 in 1 week. But here is what most people do not know. The margin increases were not about risk management. They were about protecting COMEX from delivery default. By forcing leveraged longs to liquidate, COMEX reduced the number of contracts standing for delivery. Fewer delivery demands means less pressure on vault inventory. The margin increases were a defensive move disguised as prudent risk management. Now fast forward to this weekend. COMEX is facing delivery stress again. Vault inventory is tight. Delivery obligations are high. And the CFTC is holding an emergency session Sunday night. If history repeats, Monday morning could bring a margin requirement increase. That would force immediate liquidation for anyone using leverage. If you own physical silver, margin increases do not affect you. You own the metal. But if you own silver through futures, through leveraged ETFs, through derivatives, a margin increase Monday morning could force your position to be liquidated at whatever price the market is trading. You do not get to choose. The system liquidates you automatically. This is why the weekend matters. Right now, you have time to assess your position. Are you leveraged? Are you exposed to forced liquidation? Do you own physical or paper? Monday morning, if CFTC announces new rules, if COMEX raises margins, you will have minutes to react, not hours. By the time you figure out what to do, the liquidation could already be happening. The JP Morgan position. Now let me connect this to the bigger picture. JP Morgan holds 750 million ounces of physical silver. We know this from their December 28 filing. That is 40 times more than COMEX has available for delivery right now. While COMEX is scrambling with 18.4 million ounces, JP Morgan is sitting on 750 million. Friday afternoon, JP Morgan delivered 6.2 million ounces into COMEX vaults. That is 44% of all silver delivered Friday. They are providing liquidity. They are keeping COMEX from defaulting. But they are not doing this out of charity. They are doing this because it is profitable. Think about the dynamic. COMEX is desperate for physical silver. JP Morgan has massive inventory. COMEX will pay premium prices to secure delivery. JP Morgan can charge whatever they want. And because COMEX cannot afford to default, because a default would destroy confidence in the entire exchange, they will pay. This is why JP Morgan accumulated, not just to profit from rising prices, but to profit from supply stress. When you own the only meaningful inventory during a shortage, you set the price. And right now, with Chinese supply offline, with vault inventory depleting, with delivery obligations spiking, JP Morgan has pricing power. But here is the risk for everyone else. If COMEX becomes dependent on JP Morgan for delivery, JP Morgan effectively controls the market. They decide when to provide supply and when to withhold it. They decide what price they accept. And if they decide Monday morning that the price is not high enough, they could withhold supply and force COMEX into default or emergency measures. I am not saying JP Morgan will do this. I am saying they could. And the fact that they could, the fact that one entity has that much control during a supply crisis, that creates instability. Markets do not function properly when one player has monopoly supply during a shortage. Prices become unpredictable, liquidity becomes sporadic, and retail investors get caught in the chaos. The 3 Monday scenarios. Let me walk you through the 3 scenarios that could unfold Monday morning, because understanding the possibilities determines what you do this weekend. Each scenario has different implications for your silver position. Scenario 1. COMEX muddles through. Vault inventory holds at 18 million ounces or higher. February deliveries settle without major issues. CFTC review results in no significant changes. Markets open Monday. Prices are stable, maybe up slightly on supply tightness narrative. This is the best case. Your silver position is fine. You hold and watch for further developments. Probability of scenario 1, based on the evidence I showed you, may be 20%. Possible, but unlikely given the stress signals. Scenario 2. COMEX faces partial delivery stress. Vault inventory drops below 15 million ounces over the weekend. February deliveries are met, but March deliveries look questionable. CFTC announces position limit tightening, some forced liquidation Monday morning. Prices gap down 8 to 12% on the open, then recover partially as physical demand absorbs selling. Volatility spikes. If you are leveraged, you could face margin calls. If you own physical, you hold through the volatility. Probability of scenario 2, maybe 50%. This is the middle path, where stress is visible but not catastrophic. Scenario 3. COMEX faces acute delivery failure. Vault inventory below 14 million ounces Monday morning, but 14.2 million ounces must be delivered this week. COMEX cannot meet obligations. They offer cash settlement at Friday closing price to contract holders instead of physical delivery. Confidence in paper silver collapses. Physical premiums explode to 50, 60, 70% over paper prices. CFTC announces emergency position limits, forcing immediate liquidation. Paper silver crashes 25 to 35%. Physical silver spikes 40 to 60%. The market bifurcates completely. Paper and physical become 2 different assets. Probability of scenario 3, maybe 30%. Lower probability but catastrophic impact if it happens. Now here is what you need to understand. In scenario 1, you are fine either way. Hold or sell, no major consequence. In scenario 2, if you are leveraged, you could get hurt. If you own physical, you are okay. In scenario 3, if you own paper silver, you get destroyed. If you own physical silver, you potentially make significant gains, but liquidity becomes a problem because dealers cannot source inventory. So the question this weekend is, which scenario do you prepare for? Do you assume best case and do nothing? Do you prepare for middle case and reduce leverage? Or do you prepare for worst case and convert paper to physical before Monday? What I am watching Sunday night. Let me tell you what I will be monitoring Sunday evening, because these indicators will tell you which scenario is most likely. You should watch the same things. First, COMEX Vault data. They typically update Saturday evening or Sunday morning for Friday activity. If registered inventory drops below 16 million ounces, scenario 3 probability increases significantly. If it stays above 17 million, scenario 1 becomes more likely. Second, physical dealer pricing. Check major dealers Sunday evening. APMEX, JM Bullion, SD Bullion. If premiums are holding at 20 to 25%, markets are stressed but manageable. If premiums spike above 30%, dealers are panicking about supply. That indicates scenario 3. Third, Asian market silver prices. Hong Kong and Singapore markets open Sunday evening U.S. time. Watch where physical silver is trading there. If Asian physical is trading 40% plus above COMEX paper price, that is a scenario 3 signal. Physical and paper are disconnecting. Fourth, any news from the CFTC. The emergency session is scheduled for Sunday night. If they announce results Sunday evening, read carefully. New position limits, emergency measures, temporary trading halts, any of those signals major stress. Fifth, futures market Sunday evening. CME Globex trading for metals runs Sunday evening. Watch where March silver futures open Sunday at 6 p.m. Eastern. If they gap up more than 5%, markets are pricing in supply shock. If they gap down more than 5%, markets are pricing in forced liquidation from CFTC action. These 5 indicators will tell you by Sunday night which scenario Monday is bringing, and that determines what you do with your position. If you own physical silver, let me address your specific situation based on what you own. If you own physical silver, coins or bars in your possession, here is what this weekend means for you. Best case scenario 1, you hold. Your position is fine. Physical supply stress eventually pushes prices higher, you win. Middle case scenario 2, you hold through volatility. Paper prices might drop Monday, but physical premiums will stay elevated. Your silver is worth more than paper price suggests. Do not panic sell into paper price weakness. Physical is a different market. Worst case scenario 3, your physical silver becomes extremely valuable, but hard to sell at fair value. Dealers will be paying massive premiums, but they might be rationing purchases because they cannot restock. You might own $150 per ounce silver, but dealers might only be able to buy small quantities from you. Liquidity becomes the challenge, not value. Action items this weekend if you own physical. Verify your storage security. If COMEX defaults Monday, media coverage will be massive. Do not advertise that you own silver. Check with local dealers Sunday. See what they are paying. Have a plan for who you would sell to if you decide to take profits. Do not assume you can sell unlimited quantities instantly if prices spike. If you own paper silver. Now, if you own silver through ETFs, futures, mining stocks, or derivatives, this weekend is more critical. You have counterparty risk. You are depending on the system to function. If the system breaks, your paper might not be worth what you think. SLV and SIVR, the big silver ETFs, they claim to hold physical silver backing the shares. But their prospectus allows for cash settlement in extreme circumstances. If COMEX defaults, if physical silver becomes unavailable, the ETF could settle your shares in cash at a price that does not reflect physical premiums. You think you own silver exposure. You might actually own cash settlement exposure. Silver futures and options. These are pure paper contracts. If COMEX faces delivery failure, they can force cash settlement. You do not get physical silver. You get cash at whatever price COMEX determines is fair, and their determination might be significantly below where physical silver is actually trading. Mining stocks are different. They are equity in companies that mine silver. If silver prices spike, mining stocks should benefit. But if markets are chaotic Monday, if there is forced liquidation in silver futures, mining stocks could get sold off with everything else in the short term, even if fundamentals are positive. Action items this weekend if you own paper. Consider your risk tolerance. If scenario 3 happens, are you okay with potential cash settlement at paper prices while physical trades 50% higher? If not, you need to exit paper before Monday. If you are willing to take that risk for potential upside in scenarios 1 and 2, then hold. But make the decision this weekend while you have time to think, not Monday morning when you have seconds to react. The Monday morning action plan. Let me give you a specific action plan for Monday based on what you own and what scenario unfolds. Because when markets open at 9:30 a.m. Eastern, you will have minutes to react, not hours. You need to know now what you will do. If scenario 1 unfolds, COMEX muddles through, here is your play. If you own physical, hold. The long-term thesis has not changed. Supply is still tight. Demand is still growing. If you own paper, monitor for better exit points, but no emergency action needed. If you were planning to buy more silver, you could add on any Monday weakness. If scenario 2 unfolds, partial stress, here is your play. Markets open. Silver gaps down 8 to 12%. If you are leveraged, you might face margin calls in the first hour. Be ready to either add margin or accept liquidation. Do not fight the liquidation if you do not have cash reserves. If you own physical, ignore the paper price action. Check physical dealer pricing by 11 a.m. Physical premiums will tell you the real story. If premiums are expanding while paper drops, that confirms bifurcation. Your physical is worth more than paper suggests. Do not sell. If you own paper and you are not leveraged, hold through Monday. Prices will likely recover Tuesday or Wednesday as delivery obligations are met and panic subsides. If scenario 3 unfolds, acute delivery failure, here is your play. Markets open, chaos. COMEX might halt trading. CFTC might announce emergency measures. Paper silver could drop 25% plus in minutes while physical premiums explode. If you own physical, do absolutely nothing Monday. Do not try to sell into chaos. Wait 48 to 72 hours for markets to stabilize and for true physical pricing to emerge. Your silver is valuable, but you need market function to return before selling. If you own paper, you are likely getting cash settled at paper prices. There is nothing you can do Monday morning. The decision needed to be made this weekend. If you still own paper Monday morning in scenario 3, You take the loss and learn the lesson about counterparty risk. The decision tree is simple. Scenario 1, hold everything. Scenario 2, manage leverage, hold physical, stay calm on paper. Scenario 3, physical wins big, but wait for stability. Paper loses and there is no remedy. Your 48-hour checklist. Here's exactly what you should do this weekend before Monday, regardless of which scenario you think is most likely. Saturday, verify your positions. Log into your brokerage account. Check exactly what you own. Is it physical? Is it ETF shares? Is it futures contracts? Is it mining stocks? Know precisely what you hold and what the risks are for each position type. Check your margin requirements if you use leverage. Make sure you have cash available if margin calls hit Monday. Saturday evening, check COMEX Vault data when it updates. Write down the registered inventory number. Compare to Friday's 18.4 million ounces. If it drops significantly, scenario 3 probability is rising. Sunday morning, check physical dealer premiums. Visit dealer websites. See what they are charging for immediate delivery. If premiums are spiking, that is a supply stress signal. Sunday afternoon, decide your action plan for each scenario. Write it down. Scenario 1, I will do X. Scenario 2, I will do Y. Scenario 3, I will do Z. Do not leave this to Monday morning decision-making when emotions are high and time is short. Sunday evening, 6 p.m. Eastern, watch futures open on CME Globex. See where March silver opens. A 5% plus gap in either direction tells you markets are pricing in significant Monday action. Sunday evening, 8 p.m. to 10 p.m., monitor for any CFTC announcements. Check CFTC website, check financial news, check Twitter for any regulatory news. If CFTC announces emergency measures Sunday night, you know scenario 2 or 3 is coming. Monday morning, 9 a.m., be at your computer or on your phone. Do not assume you can check markets at lunch. The first 30 minutes will determine the day. 9:30 a.m., markets open. Execute your predetermined plan based on which scenario is unfolding. Do not hesitate, do not second guess. You made your decision this weekend with a clear head. Trust it. By 10 a.m. Monday, you will know which scenario we are in. The price action, the volume, the news, it will be obvious. At that point, your decisions are made. You either positioned correctly this weekend or you did not. But at least you will know. What I am doing. Let me tell you what I am doing this weekend because transparency matters. I own physical silver, coins and bars, no leverage, no counterparty risk. I am holding through Monday regardless of what happens. If scenario 3 unfolds and physical premiums explode, I am not selling into the chaos. I will wait for markets to stabilize and for true price discovery to occur. I am watching all 5 indicators I mentioned Sunday evening. If COMEX Vault inventory drops below 15 million ounces and physical premiums spike above 35%, I am preparing for scenario 3. That does not change what I do with my physical silver, but it changes my expectations for Monday volatility. I have cash reserves available. If scenario 2 unfolds and paper silver drops 10 to 15% Monday, while physical premiums stay elevated, I might buy more physical at paper prices, knowing the physical is worth significantly more. That is a bifurcation opportunity. I am not giving you financial advice. I am telling you what I am doing, so you have a framework to think through your own situation. Your risk tolerance is different. Your position is different. Your timeline is different. But the decision framework is the same. Know what you own. Know the risks. Have a plan for each scenario. Execute the plan Monday. Final warning. 10 years from now, you are going to look back at this weekend. You are either going to say, I saw the warning signs and I prepared. Or you are going to say, I saw the warning signs and I did nothing. Both are choices. Both have consequences. COMEX Vault inventory is at critical levels. Chinese supply is offline for 3 weeks. CFTC is holding emergency sessions Sunday night. Delivery obligations are spiking. The math does not work. Something has to give. And it gives Monday morning. I cannot tell you which scenario unfolds. I can tell you the scenarios are real. The data supports all 3 possibilities. The smart money positioned Friday afternoon. You have this weekend to position. Monday morning, the decision is made for you by the market. If this video helped you understand what is coming, share it. Send it to someone who owns silver, someone who needs to prepare this weekend. Most people will not see this information because they are not looking. You saw it. Now help someone else see it. Subscribe to John OG. Monday morning, I will post an update video analyzing what happened and what comes next. I will break down which scenario unfolded and what it means for the next 30 days. and drop a comment below. Tell me what you are watching Sunday night and what your Monday plan is. The silver market is at a critical inflection point. The next 48 hours determine the next 48 months. The choice is yours. Stay sharp.